How war created the modern tax system. The IRS was born to fund the Union Army. Almost every major tax was a temporary war measure. That sounds like a conspiracy theory, but it's actually history. The taxes that define modern life, income tax, corporate tax, payroll withholding, weren't born from calm debates about fairness or efficiency. They were emergency measures, created to pay for wars that governments couldn't afford any other way. Every time nations fought on a massive scale, they had to invent new ways to fund it. And those temporary fixes never quite went away. So let's follow the money and see how centuries of war built the tax systems we live under today. In the late 18th century, the modern state was still a work in progress. Monarchies like Britain's had tax systems built on customs duties, tariffs, and excise taxes. Essentially, taxes on trade and consumption. The idea of taxing personal income was almost unthinkable. The state could tax your tea or your land, but not your wages. That changed when Napoleon began redrawing the map of Europe. The Napoleonic Wars from 1803 to 1815 were among the most expensive conflicts the world had ever seen. Britain faced a colossal financial problem: how to fund a global war that stretched from Portugal to India. Enter William Pitt the Younger, the British Prime Minister who would quietly make history. In 1799, Pitt proposed a radical idea: a tax on personal income. It was introduced as a temporary measure to fund Britain's war against Napoleon. The rate started modestly, 2 old pence per pound for incomes over 60 talents, rising to a maximum of 10% for those earning over $200. The rich complained bitterly, of course. The idea that the government could demand a percentage of your private income was seen as a moral violation, almost an intrusion into personal liberty. But war has a way of changing minds. The British public tolerated it because the alternative was losing to France. When Napoleon was finally defeated in 1815, the income tax was repealed. Pitt's successors declared that such an intrusive tax had no place in peacetime Britain. But the genie was out of the bottle. The concept of an income tax, once unthinkable, had proven its worth as a tool of national survival. When the Crimean War broke out in the 1850s, and again in later imperial wars, the income tax returned. Each time, it was supposed to be temporary. Each time, it stayed a little longer. Across the Atlantic, the United States was learning the same lesson. Before the Civil War, the federal government was funded almost entirely through tariffs and excise taxes. The idea of taxing individual incomes seemed radical and, to many, unconstitutional. But when the Union Army began mobilizing in 1861, the financial strain was overwhelming. Abraham Lincoln's government faced an existential problem. The war to preserve the Union was going to cost far more than tariffs could supply. So, in 1862, Congress passed the first federal income tax. The rate was 3% on incomes over $600, about the salary of a well-paid craftsman. The same law created the office that would become the Internal Revenue Service, tasked with collecting the money to fund the Union's armies. Once again, it was sold as temporary, just until the war was over. But temporary taxes have a habit of becoming habits. The Civil War tax expired in 1872, but it left behind a bureaucratic infrastructure and a philosophical shift. Americans had accepted, at least briefly, that the federal government could reach into their incomes in a time of crisis. And that precedent mattered, because when the US entered the industrial age, the demand for a permanent income tax came back. Progressives argued that tariffs and consumption taxes unfairly burdened workers while letting the wealthy escape their fair share. In 1913, the 16th Amendment legalized a peacetime income tax, but just a year later, the world plunged into the First World War, and that new tax would immediately transform into a war machine. World War I forced governments to think about taxation on a scale never imagined before. Total war required total mobilization, not just of soldiers, but of entire economies. In Britain, the top rate of income tax jumped from 6% in 1914 to over 30% by 1918. The government even introduced the first super tax on high earners. The language was moral as much as economic. Those who benefited most from society should sacrifice most for victory. In the United States, President Woodrow Wilson followed suit. When America entered the war in 1917, the top income tax rate shot from 15% to 77% in just 2 years. But that wasn't enough. To fund the war industries, the government also needed to tax corporations directly, and so the corporate income tax was born. It began as a wartime necessity, a way to capture profits from arms manufacturers and suppliers. Before the war, corporate taxation was minimal, mostly through tariffs or excise fees. But war changed everything. The new tax on corporate profits was framed as a patriotic duty. Companies were expected to share the financial burden of victory. By the time the war ended in 1918, income and corporate taxes had become permanent pillars of the US fiscal system. What started as an emergency wartime measure became the backbone of modern government finance. Then came the next great shock, the Second World War. If World World War. I created the architecture of the modern tax system. World War II filled it with people. Before the war, only a small fraction of Americans paid federal income tax, mostly the wealthy. In 1939, fewer than 4 million Americans filed returns. By 1945, more than 42 million did. What caused that explosion? Two words: withholding and mass taxation. In 1943, as the United States geared up for full-scale war, the Treasury Department faced an urgent problem. It needed to raise enormous sums quickly, but waiting until the end of the year for people to file taxes was too slow. Economists like Milton Friedman, then working as a Treasury consultant, helped design a new system. Employers would withhold income tax directly from workers' paychecks. It was billed as a temporary wartime measure, a patriotic convenience, but it fundamentally changed the relationship between citizens and the state. For the first time, taxation became invisible, automatic, woven into everyday life. Workers no longer had to write a check to the government. The money disappeared before they ever saw it. And once the system was in place, it was far too efficient to dismantle. After the war, Congress kept it. The infrastructure of mass withholding became the foundation for modern payroll taxes. Not only income tax, but also Social Security and Medicare contributions. World War II also normalized the idea that almost everyone should pay something. The rhetoric of shared sacrifice blurred the old boundaries between classes. Taxes were no longer just for the rich. They were for every citizen in a total war economy. If you zoom out, a pattern becomes clear. Each era of total war expanded the tax system to a new level of reach and permanence. The Napoleonic Wars created the concept of income tax. The American Civil War created the institutional machinery, the IRS. World War I created corporate and progressive income taxes as tools of national mobilization. World War II created mass taxation and withholding, embedding the system into everyday life. After each war, politicians promised to roll back the taxes. After each war, they didn't. Because once a government learns how to collect a steady flow of revenue, it rarely forgets how. The post-war decades proved it. The income tax, once designed to fund cannons and trenches, became the engine that funded highways, schools, and welfare programs. The same administrative tools built to finance destruction were repurposed for social construction. But the logic was the same. Large-scale state action required large-scale revenue collection. The wars had taught governments how to mobilize money, and they weren't going back to the pre-industrial, pre-tax age. Even today, you can trace the fingerprints of war in the tax codes we live under. The structure of progressive rates, the idea that higher incomes should pay higher percentages, began as a wartime fairness argument. The corporate tax evolved from the excess profits levies of 1917. Payroll withholding, still the backbone of modern revenue collection, was designed for speed under fire, and the bureaucracy that enforces it all, the IRS, is, at its core, a wartime institution. Its ancestor was the Bureau of Internal Revenue, born in 1862 to keep the Union Army fed and armed. The language of taxation still echoes that origin: revenue, collection, compliance. Enforcement, audits as campaigns. They, metaphors of war, live on in the paperwork. It's tempting to think of taxes as dry and technical, just numbers and percentages, but behind every line of the tax code is a story of national survival. Governments didn't expand their power over citizens' wallets because of economic theory alone. They did it because war forced their hand. In peacetime, politicians talk about limited government. In wartime, they discover how elastic those limits really are. Once a state has learned to command not only men and machines, but also money, that power is rarely surrendered. There's a saying among historians: every great tax begins as an emergency. And it's true. The income tax began as a crisis measure. The corporate tax began as a fairness measure under wartime profits. Withholding began as a logistical fix for funding armies. Together, they became the permanent arteries of the modern fiscal state. Every tax you pay is a legacy of past wars. Created to fund crises from Napoleon to World War II, these temporary measures became permanent. Wars end, but their taxes remain.